Hey traders, welcome to Charts and Coffee. Happy Wednesday, everybody. Great to see everyone. Hope y'all are doing well. And we're going to dive, as always, into your questions. But before we get there, a quick pit stop over at the Forex Factory calendar. Now, if you caught this video would have been called Building Good Habits into 2022. It's available on the Simpler Trading YouTube channel. And let's see here. Let me make sure I get the right date for you all. But if you check that out, one of the things that I did right there, Building Good Trading Habits, just a day ago, one of the things that I did is I went through some of the sites and services that I look at. All of them have a free version, so there's nothing you have to go pay for. So check that out. And this is one of the places we stop each and every morning. By the way, if you want a seasonal take on what January tends to do, that video as well, I go through that there. So anyway, what do we have going on today? We have ADP already came out. That's sort of the warm up to Friday's non-farm payroll. And then here's the biggie. We have FOMC meeting minutes, which I would have to say, based on the way that the 10-year bond and the 30-year bond, and maybe you look at the 10-year bond through the yield symbol, which is TNX. Maybe you're looking at the IEF for the 10-year, the TLT. There's so many ways to look at the action. These sold off, which is to say the yields went higher. And that might be, I think, sort of a little jockeying for position in front of what might be expected to be kind of a hawkish minutes. All right, so that's better. All right, so that's the way I think the markets kind of consider that, and that might be kind of why we had this wishy-washy, slightly bearish type of action in front of the minutes, because stonks don't like higher rates. All right, so let's get to the questions. That's what we have on the calendar by way of those hot zones that we have to keep an eye on. And so let's jump into it. First question on the topic of bonds. Love it. I watched the video on bonds. Cool. And in regards to waiting for a trigger for entry, do I wait until the candles close, or do I take them during the day if it breaks that resistance? Sure. So here's the chart. And so far, we haven't put in a lower low, which is good. We have a narrow inside day. In fact, it's actually a narrow range 4-day for those of you that follow that particular style of inside day. It's a certain number of candles that have preceded the narrow range, classic old school charting. As long as we don't take out that lower low, yes. And if we can take out the high, I would prefer it not happen before 10 a.m. Eastern. But yes, I don't. So the question is, do I wait for the candle to close? This is an easy one because I usually try to refrain from always and never do I wait for a candle to close. So thanks for the question. Great question. All right, next up, Kathy asked, PFE. I bought yesterday. Okay, nice movement lower, bearish momentum. Liquid strikes were 50 and 55. Price was 54.60. In a case like this, which would you choose? Wow, it's so barely out of the money with the 55. I mean, 40 cents. I mean, technically I would go 50, if I'm saying at or in, but if you went 55, that's fine. That's fine. Or sometimes what I'll do is I'll put in the aggro position at something like the 55 where it's slightly out of the money, and then I'll go with the in the money as we go deeper into the range. But it depends on the cost too. It depends on the cost. If this is going to be a real needle mover in terms of that 5 wide, what's the difference between 50 and 55? Sometimes cost and then also position sizing and risk will come into play. And that's going to be really more of a trader to trader issue. Everyone has a different risk tolerance and account size. So that might be a little bit more of a personal choice, but 55 would probably be fine. Okay. I mean, so barely. Now, you might say, okay, Rod, but what if it was trading at 54 even or 53? Then it becomes incrementally more obvious to go with the 50. All right, next up is, can we take a look at Lucid? And let's see, as far as looking at, and I have no, let me mention this, and I think this is really important. When I have skin in the game, for example, I don't have PFE, but I am looking to get into XLV, right? So I do want to make it really clear when I do have skin in the game or I'm going to be playing a certain name. I have no skin in the game in Lucid. However, it is looking kind of interesting for maybe a momentum move to the upside, specifically to the upside. A couple things here you'll notice on the chart. It's non-trending. It has been since, as you can see here, December 7. We've had a few bouts of really nice, narrow 4 blue grab candle in a row action. Here's what I'll say. The Darvis has done the heavy lifting. Here's your resistance. Here's your support. Let's paint that green. There's your resistance. There's your support. Once we get 4 blue grab candles in a row, that really then starts to increase the likelihood of some sort of momentum breakout, having better follow through once it's actually broken out. But I can say I'll sometimes front run the process, meaning I'll get in before the breakout by taking advantage of a move to the support level and then giving myself time. Because one of the things that's really tricky with sideways markets is that they can go sideways for a while. And while I'm bullish on this, the trend that preceded the chop was up. It's a couple ways you can play that, and that's probably the way that I would look at it. But I have no skin in the game on that one. Okay. All right. So next up. Great question. Tony asks, is there sector rotation happening? I do not believe so. Let me show you why. Okay, so these are the US sectors. You can see through here. Okay, and for sector rotation to be happening, I see a little bit more participation. It's hard to say in the early stages, but what is interesting and what could be a good argument for yes, it's happening. It's a little early to say, but this would be a good argument for yes, it's happening, is XLF, XLI, and XLE. XLF, XLI, and XLE moving higher. These are this orange, green, and purple. See how these are moving higher after they were your bottom 3? Okay. Look what's moving lower. We have XLK moving lower. We have actually XLV dipped a little bit. So if we're seeing rotation, it's the top, sort of the top of the food chain here. Some, not all, moving lower, while the bottom of the food chain, if you will, kind of moving higher. So maybe, hard to tell that if, look, sector rotation means something else has to be gaining while something else is losing ground. And the suggestion of that is that money's coming out of the strong, arguably overbought stuff and moving its way into the weaker corner of the weaker corners of the market. And the weakest would be down here at XLC. If I'm really looking at rotation, I would think XLC might benefit. But funny enough, VINF, I'm sorry, Energy, industrials, and financials, those were down near the bottom. So not quite as weak as C, but so maybe we could be seeing that. And that's how I track it. That's how I track it. So I hope that makes sense. All right, Tesla. Sure. So I've talked about Tesla in the last few charts and coffees, which is cool. I mean, Tesla is one of the names that we know is heavily weighted within the indices, S&P and Nas. We know it's heavily weighted within the XLY. So there's your range in Tesla. Tesla's been in chop since the 3rd of December, no longer in a trend. Not that it can't move higher, but when it moves higher and lower, it's going to be a matter of overbought and oversold. And if you haven't checked out my walkthrough of setting up a slow stochastic, this has been my go-to for 30 years. I don't get cute with it. It's a 2080. It's a 21K 3D. You can set that up on almost any platform. Just make sure it's a slow stochastic, not a regular stochastic. Most people use regular. I prefer the slow, and then I slow it way down. You can check that out. It's the video that I did on how to trade the chop in crude. It's a video that you can check it out at the Simple Trading YouTube. I'll walk through all the details. So as we get down, and notice also, you don't want to follow this blindly, right? I don't care what the secret squiggle says. And this is my setting on the secret squiggle, right? I think a lot of times we fall in love with our settings. We fall in love with our indicators. It's okay to pay attention to them, but remember, they use price, open, high, low, close in some sort of little algorithm to spit out an interpretation of what's happening on the price chart. Start with the price chart. Start always here, then here. Or if you like to find opportunities on the secret squiggles, check it against the price chart. And so what I mean by that is use the Darvis. Notice that both these lines are not arbitrarily drawn. They're pre-drawn by the Darvis. And then I'm looking at the secret squiggles. So right now, yeah, we're overbought. Darvis, we've topped out here about 3 times. Doesn't mean that we're going to sink down to the bottom of the range. That's the other misnomer about range-bound markets. I'm looking for maybe a gap close. I'd love to see a gap close. That's what this line right here, this green line right in here, is waiting to alert me to. All right, I'll just change it to yellow. And that at that point, that would be a really interesting level to get long Tesla. Hope that helps. All right, next up, Hal asks about TMO. Oh, Thermo is an interesting one. It's been a relative outperformer within healthcare. It's sort of outside the melee of these sudden moves in certain stonks within the healthcare because of the COVID implications for their products. So this one's tricky. This one just fell out of bed. Now, it fell out of bed. Now, what do you do when you have a pullback that just keeps going, right? What do you do? Well, let's go back and take a look at the move on the 3rd of January. Now, let me see here. Just take me a moment. Let me see here, because I don't know the number off the top of my head, but what's the typical movement per day in Thermo? What's the average? About 12, 11, 12, right? At 11 to 12 points, the upper end is 15. So keep that number in mind. This day right here, that first pullback, look, let's forget about the red because we didn't know the red was coming. So let's ignore this for now. This right there, that was a 20, how many points was that? 22 point down day, right? This is 22. What's the normal I just said? 11 to 12 with the upper end being 15. Once we exceed 15 points, something is different. Something should get your attention, should get our attention in terms of, hey, wait a minute. The normal price action, the historical volatility has been smashed. What's going on? And so you will only know that once you exceed a move lower of 15 points or a move higher, whatever the direction is. But once you exceed that historical price movement range, we have to take a pause And the same thing could have been said right in here. Wait for an inside day, wait for a pause candle, wait for a minor low. When you hear me talk about that, that's usually why. Either we're at an inflection point within a range or within the context of a pullback. The way the market pulled back was beyond historical norms. And it's sort of a shot across the bow, letting us know, hey, something's not right here. There might be something else afoot, right? And we give it a moment. So I hope that helps. But in the meanwhile, we do have support down here. I'm not bearish. Please know I'm not bearish. This is simply turned into a trend break and now bordering an oversold buy. And then, if we can get a nice reading on the slow stow that is oversold, and I did down in here too, that would just confirm it that much more. But the Darvis is enough. If I get Darvis plus a secret squiggle, cool. But I don't need it. It's just really nice to have both. All right. So I hope that helps. Jim asks, Raghee, in the Sector Secrets Mastery, are there plenty of trades for small account directional calls or puts? I don't have margin for spreads. Okay, great question. Thank you, Jim, for the question. Number one, I'm not a fan of margin accounts. If someone's learning how to trade options, my belief is this, and this is the way that I was taught. It doesn't mean it's the way for everybody. I can only share my path, right? That's what our job is on this side of the mic and camera. How did we get here? I don't believe in, the only reason I have any margin account is I trade futures and Forex, and I have to trade those through margin accounts. In the Sector Secrets, in any of the classes where I've shown my options trading, it is a cash account. I think early on, maybe in 2017, I still had a margin account. I might have put on a call vertical in that. But I mean, if to tell you that I might have put on a call vertical back then, it was maybe one of 4 that year. My belief is that multiple leg strategies are usually designed for retail traders to be able to afford symbols, options that normally are unaffordable. Why do we put on a call vertical? To protect downside? Sometimes, but mostly to offset the cost of a really darned expensive option. Why do we put credit spreads? Do we want to collect credit? I think that's really more a function of it's a $45, $55, $65 option, and it just is more affordable to collect the credit and then, protect that with the put credit spread, that second leg, than it would be just playing directional. So you might say, Rod, you buy $45, $55 options? Barely. Seldom, unless the setup is beautiful. And even then, sometimes I'll consider a call vertical. But really, I like directional calls and puts, because here's the bottom line, and I believe this down to my marrow. If a trader cannot determine direction and timing, I don't care what kind of multi-leg strategy they want to deploy. It's not going to override that fundamental misunderstanding of option pricing and timing. My opinion, that's all. So to answer your question, and I want to answer more than, yeah, we do that. Yeah, I mean, we seldom buy options over $7. We seldom, actually, we never, almost never. I can't remember the last time I sent out some sort of multi-leg strategy. I teach you all how to do it, because think of it this way. Once you understand the timing of how I buy a call or how I buy a put, here's what's so fascinating about that, and this is where it's so overlooked. Once you know how to do that, that same timing will be a put credit spread. That same timing will be a call vertical. So get the timing down to that directional, just like you said, and you're set. So the answer is yes. I mean, it's not a small account thing. That's not what we tout at all. We have a great small account service. This is about scalability. This has always been the mantra that we have shared. Scalability. In other words, if you have a $10,000 account, $110,000 account, $1 million account, the only thing that changes is the number of contracts that you trade. So liquidity is important. Scalability is important, meaning the only difference between the way that I trade a 6 or 7 figure account and the way that I did once upon a time trade a 4 and 5 figure account is the number of contracts that I trade and the cost. Sometimes cost is going to be prohibitive to certain size accounts, but you'll get there. Just like on the first day of the gym, we're not squatting 2.25, right? Or maybe squatting an empty bar to get our form right. And then eventually we're going to lift heavy weight. Yes, I can squat 2.25. I'm very proud of that, I will say. We don't get there on day one. We'll break ourselves in half trying to do that. So remember, risk tolerance is like a muscle, and you will develop it. I promise. Just develop the good habits when your account is small, and then it's scalable. All right. So I hope that helps. My thoughts on NEE, Trisha, it's on the radar. It's something we actually will look at in small, not a small trade. I will look at it. You know what? Here's what I'm thinking. I'm looking at XLU. It might be a small trade that we put on, and it might accompany some of the other heavily weighted names within the XLU. I'd rather go XLU. I'll tell you straight up, because that allows us that nice dilution of many of the strength names within the utilities sector ETF. But NEE could be a nice small trade we put on. It's pretty affordable. It's pulling back. Yeah, it's definitely on the radar. And speaking of the radar, I'm going to jump on over into the Sector Secrets room. Today is our weekly live trading. So let me just grab a couple more questions, because I'm pretty sure a lot of our sector folks are in this room. NUE, no interest in, Roland. It's choppy until it gets to the top or bottom of the range. Really not something that I would typically gravitate towards. Michael, I use something called Visible Range Volume Profile. It's free within TradingView. So you can check that out. It's a free tool. I love free tools. I have a number of premium tools that many of you know that I've taught with classes, but a lot of my tools on this chart are free. You can grab the grab candles for free. You can grab the original 2.0 Darvis for free. We have propulsion dots available for free. So, I would like as much as possible you to be able to invest in your education and in your membership and in your account, right? And so I try to offer and point out as many of the free secret squiggles as I can. And that is one that's built in specifically to TradingView. All right. Okay. With that being said, let me wrap it up there. Thank you as always for all your time. I did see the euro question at the very bottom. I want to short the euro. I want to buy the dollar. I'll see you all tomorrow. Be good to each other.